Most people don't go broke because they don't make money. They go broke because they build their finances upside down. They start at the top with speculation, fast money, trading, crypto, options, or the next big thing. But they never built the foundation. And when life hits them, layoffs, divorce, illness, bad markets, everything collapses because there was nothing underneath it. Today, I want to show you a framework I personally use when thinking about money and risk. I call it the asset pyramid, and everything I teach about money fits into the structure: safety, growth, speculation. Before we dive in, quick disclaimer: this is not financial advice. I'm not a licensed advisor. Everything here is for educational purposes only. Consult a professional for your situation. The reason people build their finances upside down is simple. The internet trains you to chase the top of the pyramid first. You see? Crypto millionaires, stock traders, Lamborghinis, fast money. What you don't see is the boring foundation underneath: emergency savings, low-risk assets, stable income engines. That part isn't sexy, but it's the reason some people survive downturns while others get wiped out. The way I think about assets is simple. Everything falls into three categories: safety assets, growth assets, speculative assets. Each one serves a different purpose, and if you mix them up, you create financial chaos, but when you structure them correctly, you build a financial life that actually lasts. The bottom of the pyramid is safety assets. These exist for one purpose: survival, not profit. Survival. This includes things like emergency funds, cash reserves, high-yield savings accounts, low-volatility bonds, physical precious metals like gold and silver. These assets aren't meant to make you rich. They are meant to keep you alive when things go wrong. Imagine losing your job tomorrow, or getting injured on a job site, or the economy crashing and construction slows to a crawl. If your entire financial life is built on speculative investments, you're forced to sell at the worst possible time, locking in massive losses just when you need cash most. I've seen it happen too many times. Guys in trades who rode crypto or options high then got laid off during a downturn and had to cash out their portfolio at rock-bottom prices. They didn't just lose money, they lost years of progress because they had no buffer. But if you built the base of the pyramid first, you can survive. You cover your bills, keep food on the table, and give yourself breathing room to find the next gig or wait for the market to recover without panic selling. And survival buys you time. Time is the real advantage. Time to rebuild. Time to let good investments recover. Time to stay in control instead of reacting out of fear. There's another category many people completely ignore when building their pyramid: physical luxury assets. Tangible items that can hold or even grow in value over time, especially if they're rare, well-made, and in good condition. Things like fine art, original paintings, or limited edition prints from established artists. Rare watches, vintage Rolex or similar collector pieces. Collector cars, classic muscle or limited production models, and even silk Persian rugs. Real handmade, antique or high-quality ones. Yes, real handmade Persian rugs. Some of these take significant time to create. Smaller sizes like 3 by 4 feet or 3x5 feet might take a skilled weaver 6 to 12 months of full-time work, while bigger ones can stretch to a couple of years or more, depending on the knot density and design complexity. They use natural dyes, high-quality silk, and intricate patterns passed down through generations, making them labor-intensive masterpieces. In certain markets, well-preserved ones function almost like portable wealth, easy to store, transport, and often appreciate better than cash during inflation, while doubling as beautiful home pieces. Now, I'm not saying go buy rugs or any of these. Instead of paying your bills, building your emergency fund, or focusing on productive assets like a business or rental property. These aren't quick flips. They require knowledge, authenticity, condition checks, patience, and sometimes higher upfront costs plus ongoing care like storage and insurance. But the point is this: some physical items are true assets. not just decoration or status symbols. They can provide diversification, inflation protection, and real enjoyment. Understanding the difference between consumption and smart, tangible wealth building matters a lot when you're structuring your pyramid correctly. The middle of the pyramid is where real wealth starts. These are growth assets. These are the assets that generate income or utility. Things that actively produce cash flow or provide ongoing value rather than just sitting there hoping for price appreciation. Examples include rental property, businesses, skill-based income, equipment, other productive assets. Rental property. Buy a house, duplex, or small multifamily unit. Fix it up, especially if you're in trades. You can do a lot of the work yourself to save big on costs and rent it out. After covering mortgage, taxes, insurance, and maintenance, you pocket positive monthly cash flow. Many tradespeople start here because they understand repairs, can spot good deals on fixer-uppers, and turn them into steady income streams. Businesses. Your own contracting company, welding shop, auto repair garage, or electrical service business. These scale with your skills and crew. Hire apprentices, take on bigger jobs, add services like maintenance contracts. The business itself becomes the asset, generating recurring revenue from clients who need you repeatedly. Skill-based income. This is huge for tradespeople. Your expertise is the asset. A welder who builds custom trailers or does mobile repairs on the side, a mechanic who runs a small shop or offers fleet maintenance contracts, an electrician who installs solar panels or smart home systems as a side hustle. These create cash flow through hourly rates, project fees, or retainers, often $50 to $150 an hour depending on specialization. And you can scale by training helpers or turning it into a full business. Equipment. Tools, machinery, or vehicles that pay for themselves. A backhoe, welding rig, diagnostic scanner, or work truck bought for your trade that you rent out when not in use, or use to take on higher-paying jobs. Productive gear that generates income repeatedly, not just one-off use. Other productive assets. Things like vending machines and job sites, storage units you build or buy and rent, or even a pressure washer rig for mobile detailing or cleaning services tied to your trade skills. The key here is cash flow creation. These aren't passive bets on the market going up. They're engines you build and control. You put in work up front, skills, sweat equity, smart purchases, but over time they spit out money month after month, building real wealth while you sleep or take on more projects. This level separates people who trade time for money from those who make money work for them. Start small. Maybe a single rental or side gig with your tools. But focus here after your safety base is solid, and you'll see compounding growth that speculation alone can't match. This is the zone where real tradespeople separate themselves from the pack, not waiting for markets or bosses, not chasing one-time paychecks. A certified welder rolls up with his own trailer, plasma cutter, and full setup. Every structural job, pipeline repair, or custom fab pays him directly, over and over. A diesel mechanic builds out a bay with hoists, scan tools, and parts inventory. Trucks keep breaking down, fleets need preventive work, and that diagnostic revenue rolls in weekly. A general contractor assembles his reliable crew and lineup of subcontractors. Projects stack, change orders add margin, and the next bid is already in play. These aren't hobbies or side gigs. These are self-sustaining income machines powered by your hands-on trade mastery. The difference? You're not hoping for appreciation or passive checks. You're engineering repeatable cash flow through the one thing nobody can outsource: skilled execution at scale. Your trade isn't just a job. It's the foundation of an asset that compounds every time you or your team deliver. Build it right, and the money doesn't stop coming. This is exactly where most people mess up big time. They mix up real assets with flashy lifestyle buys. Take that shiny new luxury sedan or high-end SUV sitting in the driveway. It feels like success on wheels. Leather seats, all the tech, that new car smell. But here's the brutal truth. The second you drive it off the lot, it loses 15 to 20% of its value in the first year alone, then another 10 to 12% the next year. By year 5, you're often down 50 to 60% or more from what you paid, unless it's some ultra-rare collector classic that actually appreciates. Like a vintage Ferrari or limited edition muscle car. It's not building wealth, it's pure consumption. It costs you money every month. Payments, insurance, gas, maintenance, tires. Nothing wrong with enjoying nice things. Treat yourself. But call it what it is. A liability that drains your pocket, not an asset that fills it. True wealth builders put money in your pocket repeatedly. Lifestyle purchases take it out. Know the difference, and your path to financial freedom gets a lot clearer. Now we climb to the very top of the pyramid. The sharp, glittering peak most people dream about, but few master. Speculative assets. This is the high-stakes territory. Cryptocurrencies like Bitcoin that can swing 5 to 15% or higher in a single day during turbulent times, with extremes hitting 20 to 30% plus in full mania or panic. Altcoins and smaller tokens routinely amplify that volatility, often doubling it or more with 20 to 50% plus moves, sometimes 30 to 70% wipes. On hype, pumps, dumps, or whale action. Options trading where a perfectly timed call or put explodes your capital overnight. High-risk growth stocks or meme-driven plays that rocket on social media frenzy. Short-term day trading or swing trades chasing momentum. These can deliver massive, life-changing gains. We've seen small bets turn into fortunes in weeks when the stars align. But the downside is brutal and asymmetric. Bitcoin swings are already intense, often 5 to 15% in a day during volatility spikes. And altcoins? They take that and crank it up. Lower liquidity means a big whale sell-off or tweet can wipe out 30 to 70% faster than you can react. One wrong move and positions evaporate. That's why I compare speculative assets to chainsaws. A chainsaw is insanely powerful. In skilled, careful hands, it builds, clears, and dominates. In untrained or reckless hands, no safety gear, no plan, no respect. It destroys everything in seconds, including the user. Speculation isn't gambling if you approach it as a disciplined skill. With strict rules, position sizing, and only risk capital, you can lose entirely. But most people swing wildly without training. They get cut deep. If you're stepping to the top of the pyramid, eyes wide open, systems locked in, and no ego. The upside is electric. The fall is merciless. Speculation isn't evil. It's just misunderstood and often mishandled. The pros don't jump into high-risk plays as their first move. They build the foundation first. Steady income engines from skills, businesses, or cash-flowing assets. Only then do they speculate with proper sizing. A failed trade might sting, but it never threatens the whole empire. They risk what they can afford to lose, and never what they can't live without. That's the difference between gambling and intelligent speculation. Get the base solid, then you can swing the chainsaw safely. One of the biggest rookie mistakes in speculation? Jumping in with rent money, or emergency savings, or cash you'd lose sleep over if it vanished tomorrow. That's not smart speculation. That's straight up gambling with your survival. Real speculation only happens after you've built a rock-solid base. Reliable income streams, emergency funds, and assets that pay the bills no matter what. Protect the foundation first, then, and only then, take calculated swings at the top. Anything less and one bad trade can wreck everything. Here's the uncomfortable truth most high earners ignore. High income doesn't protect you. There are doctors pulling $400,000 a year. Surgeons and specialists who are flat broke or one paycheck from disaster. Why? They built their financial pyramid upside down. Luxury cars, big houses, private schools, exotic vacations, speculative bets. All stacked on top with zero foundation. No emergency fund, no real assets producing cash flow, no safety net. High income can camouflage terrible structure. Right up until the income stops, the market crashes, or life hits hard. Then the whole thing collapses. Build the base first, or the height becomes your downfall. The correct order is dead simple. Build safety first, Grow income second. Speculate last. Safety, growth, speculation. That's the sequence that lasts. Get it backward, and the whole structure crumbles when pressure hits. Get it right, and every level above the base becomes fuel, not a threat. Stick to the order. Everything I teach about money fits into this one structure: safety, growth, speculation. It's not the only way to think about assets, but it's a framework I personally use to organize risk. And once you see it, you start noticing how many people build their finances upside down. The real goal here isn't just stacking more money in your account, it's building something unbreakable, something that doesn't crack when life inevitably pushes back. Economic downturns hit, markets crash, jobs shift, health issues arise, family emergencies show up unannounced. That's when most financial setups collapse, because they're built like a house of cards, tall, flashy, and fragile. This pyramid is different. It starts with a wide, rock-solid base: safety nets, emergency funds, reliable income from skills or assets that produce cash flow no matter the headlines. Then a steady middle layer: growing businesses, productive equipment, recurring revenue streams that compound quietly. And at the very top, just a small, controlled peak: speculation, only with money you've already earned and protected. When stress comes, and it always does, the base holds firm, the middle keeps producing, and the top is small enough that a bad swing doesn't topple everything. Build wide at the bottom, grow steady in the middle, speculate small at the top. Over time, every layer reinforces the others. The pyramid doesn't just survive pressure, it gets stronger under it. That's real financial freedom, not chasing highs, building something that lasts.